Getting the scope wrong at the start of a tax engagement creates problems that multiply through the entire life cycle of a filing. Initial statutory classification is the absolute foundation of compliance within the UAE corporate tax regime. Looking at this representation of a standard filing architecture, you can see how a single error in assessing a client's scope during onboarding initiates an immediate, severe chain reaction. The first casualty of placing a client in the wrong category is the timeline. The error fatally miscalculates the statutory registration deadline, exposing the entity to immediate administrative penalties before the first return is even drafted. From there, the misclassification corrupts the required format of the return itself, applying the wrong reporting standards to the underlying financial data. Ultimately, these compounding structural errors invalidate the final tax liability calculation entirely. To prevent these structural failures, we need to remove guesswork from the onboarding process. We do this by constructing a definitive algorithmic decision tree based directly on the UAE framework. Every entity analyzed through this model will route into one of three ultimate destination categories: resident person, non-resident person, or exempt person. Systematically pushing every new client through this precise statutory logic is the only guaranteed method to safeguard their entire compliance lifecycle. We start our categorization model with the first statutory question: is the entity natural or juridical? The law defines a juridical person strictly as a company or a legal entity. The baseline rule is direct. UAE incorporation automatically triggers residency for corporate tax purposes. This automatic residency explicitly includes all free zone entities. The statutory trigger is absolute. Once established under UAE jurisdiction, residency classification is locked. Consequently, the physical location of the executive team is completely irrelevant if the entity holds UAE incorporation. Likewise, the geographical source of the income earned has zero bearing on this automatic trigger. However, a critical override rule captures entities not incorporated within the country. This is the effective management and control test. If a foreign company's strategic decisions and operations are executed in the UAE, they are pulled into UAE residency. Juridical residency tests both paper and practice. It's dictated by formal establishment, but equally enforced by where the actual functional control operates. Returning to the top of our tree, we follow the statutory logic for individuals. Professionals often assume individuals are immune to corporate tax. They aren't. Natural persons become resident persons if they conduct a defined business activity in the UAE. The activity alone isn't enough. The framework applies a statutory revenue threshold. To trigger residency, the total turnover generated by that business must exceed 1 million dirhams within a single calendar year. If an individual's business activity falls below the 1 million dirham threshold, they stay entirely out of the corporate tax net. Practitioners must still be diligent here. While an individual may avoid corporate tax below the threshold, other compliance obligations like VAT may still require strict monitoring. Unlike the automatic classification of domestic companies, residency status is highly conditional, volatile from year to year, and entirely dependent on revenue volume. This leaves us with the foreign juridical entities that fail both the residency and the management tests. They route into the non-resident person category. Classifying a client as non-resident does not mean they have escaped the UAE tax net entirely. Three specific statutory mechanisms capture revenue from non-resident entities. The first mechanism activates if the foreign entity maintains a permanent establishment within the UAE. The second captures entities deriving UAE-sourced income, even without a permanent establishment. The final mechanism is highly targeted to close physical presence loopholes. Known as the nexus rule, it captures foreign entities earning income directly from immovable property located in the UAE. Absolutely no physical operational presence is required for the nexus rule to capture an entity and subject that specific property income to taxation. The non-resident category operates as an aggressive compliance web built to tax economic value generated within UAE borders, regardless of where the earning entity is anchored globally. Our final category is exempt persons. This area requires extreme caution, as practitioner complacency here creates the highest risk for severe onboarding errors. The decree law lists standard exempt categories: government entities and natural resource businesses subject to emirate-level taxation. The list continues with qualifying public benefit entities and qualifying investment funds. Finally, it includes pension funds and specific wholly owned UAE subsidiaries of exempt persons. The fatal flaw in analyzing scope is assuming that meeting these statutory criteria grants an automatic exemption. Almost all of these exemptions require proactive verification, culminating in a formal application or notification submitted directly to the federal tax authority. Failing to formally secure FTA approval leads to stark outcomes. A practitioner will either over-register a client unnecessarily, or worse, fail to register a client operating under the illegal assumption that they are exempt. Looking at the fully constructed categorization model, we have a clear, logic-based pathway to assess any entity. The specific bucket a client lands in dictates their exact registration deadline. It dictates the precise format of their return, and crucially, determines whether they have a legal requirement to file in the first place. However, you cannot rely on static legal assumptions when applying this model. Practitioners must rigorously verify every single classification against the original decree law criteria and monitor all FTA public clarifications. Tax guidance has been refined and altered multiple times since 2023. Operating on outdated assumptions transforms a standard onboarding process into a severe liability. Establishing scope is only the preliminary hurdle of an engagement. Once categorization is locked, the real analysis begins. The mechanics of the actual tax calculation will consume the majority of your working hours. Accurately mapping a client's jurisdictional scope is merely finding the right door. The heavy lifting lies in the complex and demanding translation of their raw accounting profit into statutory taxable income.